Welcome back to Invest Global. Today we're analyzing the Federal Reserve's balance sheet, basically breaking this down and helping you understand a little bit better why this is an important indicator personally that I like to track when you're looking at the macroeconomy. The other things that I like to watch as well are the US dollar index, crude oil, and 10-year Treasury yields, which fit in perfectly with what is going on here, especially with those T-bills, the 10-year Treasury yields, because that's pretty much those and the mortgage-backed securities are the number one thing the Federal Reserve is buying up when you're looking at the balance sheet. Again, every company has a balance sheet. Hopefully you know your own personal balance sheet when you're looking at assets versus liabilities. Typically with the Fed, it's a bit different, right? It's everyone else's balance sheet. They really have to work for getting into these assets. Typically, if you're looking at the different kind of socioeconomic classes, lower economic class, typically they're taking out consumer debt and they're buying liabilities, right? They're spending money on dumb clothing, they're spending money on all these things that are just liabilities. Then you would say the middle class is kind of in between, right? So that's where they probably have, they put their money maybe into stocks, maybe in their 401k, and they have like a 9-to-5 job, they have a retirement plan, but they're not really getting, they don't really understand the financial system as well as a lot of the wealthiest people in the world do. What the wealthiest people in the world do is they use debt to buy assets, right? So this is what's going on here, and they know how to do it properly, especially with things in real estate you can do to kind of roll up your taxes properly. But that's not really the topic of today's video. That's just kind of explaining, okay, when you're looking at balance sheets, besides the Federal Reserve, how basic overview there. When it comes to the Federal Reserve, they're a bit different in a situation. They basically have a monopoly on money printing, right? So when you're looking at the Federal Reserve and the Treasury, I have a video on this basically explaining how this whole system works with issuing new debt, buying it up, with the Treasury and the Federal Reserve, how this kind of works back and forth. But essentially what you want to understand here is when you see this increase in the Federal Reserve's balance sheet, what does this mean? Well, they're essentially buying up assets. Really, it's government debt. Okay, so mortgage-backed securities. You also have treasuries, so things like bonds. You ask your friend, your parents, whoever it is, hey, when's the last time you bought a bond, right? When's the last time you bought a government bond? Typically, this does not happen. It's very interesting. Typically, like retail investors are people that are the net sellers, and the Federal Reserve is the net buyer, right, of treasuries in general. So when you're looking at this balance sheet here, just from 2008 to let's see, where are we? Yeah, we're tracking all the way up to 2021 right here. But you see kind of a slow rise here, a bit of just like horizontal moving. And then this massive push up right here. And now we've just been in this kind of parabola. So if you're also, another decent website to look at this is the Fed. This is the St. Louis Fed, basically showing you the exact same thing, right? But the whole point here to understand is, okay, how can you hedge against this, right? So if you know this is going on, if you understand that, okay, the Federal Reserve basically has this credit card where, hey, they have 0% interest, they can do all these different things, and they're kind of increasing this balance sheet over time, but they're not really working for, obviously it's a bit more complicated, this is a generalization, but they're not really working for this new money injected into the system to buy up these assets, right? So assets and liabilities, in my opinion, a good way to hedge against this is obviously inflation hedge assets, right? So you're looking at hard assets like physical gold, physical silver, some real estate. I personally like a lot of different commodity stocks, so commodity producers. Not the biggest fan of U.S. equities currently. I love currently here in Krakow, Poland. Love markets like here in Poland. I think they're incredible. Love different emerging market investment opportunities, and I also love blockchain. So I think that there's a lot of opportunities out there in the investment space. But the main thing, when you see this trend happening, okay, what's the worst thing you can do? The worst thing you can do is staying in dollars. Okay, so first of all, you want to get rid of consumer debt. That's the number one thing. Look at your balance sheet, assets, liabilities, focus on the assets part, try and get out of the liabilities. So, if you have a car lease and it's a Mercedes-Benz or whatever it is, and you just have it to keep up with the Joneses, get out of that. Get out of the liabilities. In my opinion, most cars are liabilities unless you're looking at them as a store of value. Like, I guess you could make the argument for that. Personally, that's not something that I like to be in. I don't really think it's that liquid of a market. Some people say hey, old trucks are a great investment. Hey, I'm not going to argue with you, but personally, I think there are other places you can be in. Besides that, I mean, it's starting to rain a little bit here. I'm on this rooftop, so I'm going to wrap it up here. But this article lays it out relatively well, but just kind of hoping you guys understand this a little bit better in this video. It's a real quick one, though. So you can see this is the actual 10-year Treasury yield or bond yield, whatever you want to call it. And this is what I was talking about. This is an interesting thing to follow for kind of a macro indicator, and also the US dollar index and crude oil. And you can see as the balance sheet increases, it also affects all these other things, right? So I think the S&P is a good way to see this. It's like up and to the right if you're denominating it in US dollar terms, but you denominate it in something like gold, down and to the right, okay? So that's basically all for today's video. If you guys have any questions, let me know in the comments down below. You can also join the Telegram group, link down below in the description. Besides that, invest global, and until next time. Also, like the video if you liked it, subscribe. If you didn't like it, let me know in the comments. Dislike the video if you didn't like it. Subscribe to the channel, stay up to date, hit the notification bell and all. That's all for this one. Invest global, and until next time.